And according to the Taylor rule, rates are exactly where they should be. If inflation pushes higher, and if it's uncomfortably high, then there's going to be a case to be made for increasing interest rates. Nobody in the financial markets is prepared for an increase in interest rates. 90% probability of a rate cut suggests that everyone is assuming, 90% are assuming that we're going to get a cut. If we actually stay flat or move higher, I think that's where you have outright panic in the equity markets. And we could set up for declines that we haven't seen in a lot of years, 20-30%, just to get things started. Off of these kinds of valuation peaks, it would not be uncommon to see a 50% decline in equities. And when I say off of these valuation peaks, if you look at trailing price to earnings, if you look at forward price to earnings, if you look at the cyclically adjusted price earnings ratio, if you look at price to book, if you look at EV to EBITDA, if you look at the Q ratio, if you look at the Buffett ratio, or want to combine those into an index, we are at the most overvalued the stock market has ever been. That takes out 1929, takes out 1966, that takes out 1999, that takes out 2021. And so we're at these levels where everyone's assuming one thing about Fed policy. If the Fed zigs when the market thought they were going to zag, disappointed expectations on Wall Street, outright selling, liquidity starts to dry up very quickly.